I've been hearing this a lot lately from my clients. Tony, I want to purchase a house. We're going to purchase a house. We have the credit. Our credit's good. We have the income, but we're going to rent for another year, maybe two, because we want the down payment. Now, I want to preface this whole video with this. There are some cases where you should save up a large down payment. But if you're, for example, say a first-time home buyer where there's programs out there where you can have no down payment, or if you're my viewers who are listening in the St. Louis area, there's down payment assistant programs that will get you up to $10,000 of down payment help that even a lot of real estate agents don't know about. So in this video, I'm going to give you all of the information, how it affects you on the short term, how it affects you on the long term, so you have a complete picture to be able to make your decision on how you want to proceed with your next home purchase. You ready? Let's do this. These guys over here, this is Bill and Suzy. These guys have the credit, they have great income, and they're first-time home buyers. But Bill really likes to think pretty analytically, and he's really concerned about the financials when it comes to their home purchase, especially on the down payment side. So what they're considering right now is, even though they have the credit and they have the income, they can get pre-qualified for a loan. They're considering taking a year, going to an apartment, renting for that year, and then saving up enough money for the down payment to then purchase the home in about a year. So that's Bill and Suzy over here. Our next couple I want to introduce you to is Rick and Lucy. Now, Rick and Lucy are in a very similar situation to Bill and Suzy, where they have the credit scores to be able to qualify for a loan. They also have the income to be able to qualify for that loan. And right now, their conversation is, do we save up the down payment, or do we just go for a loan program that is going to have either no down payment, or we look at some down payment assistance programs that are available in St. Louis and St. Charles County. Now, if you're not watching this in the St. Louis area, contact a local real estate agent, because these types of programs exist all over. But for my clients that are in the St. Louis area, there are programs in St. Charles County and St. Louis County, and also Warren and Lincoln County. The programs work a little different that way, but that will give you down payment assistance so you can purchase your home. So as these guys are both talking at their dinner tables, here are the things that they're weighing out. And I'm sure it's very similar to the same things that you're weighing out. First, let's talk about the short-term financial impact of either scenario and what it would have on their finances. Now, what I mean by that is really monthly payment. When you put more money down, obviously you're reducing the amount that you're borrowing, so the money that you pay monthly is actually going down. And this is a great thing to look at. You should protect the cash flow that's coming into your home, right? So if you can get monthly payments that are lower, that's definitely going to help you, right? Now, here's the thing. I will say you are going to gain just a little bit when it comes to this side on the financial equation of, do we put a down payment or not? Let's run some numbers. Now, when we talk about these scenarios, we're going to say both of these guys are purchasing a $300,000 house. And if they don't purchase the $300,000 house, they're going to be renting an apartment for around $2,000 a month. Their goal is to only rent for a year, so 12 months. And that's both of these guys' scenarios. So both of them have good credit. Both of them have the income needed. They can both qualify for a loan. And then also they're looking to purchase a $300,000 house. And if they don't purchase the $300,000 house, if they decide to press in and save the money from the down payment, they're going to rent an apartment, and that apartment cost will be about $2,000. We're going to look at all of those numbers and how it impacts both Bill and Suzy and Rick and Lucy, both on the long term and the short term. And your situation is going to be very similar. Now, spoiler alert. If you want to know your specific case, because if you are watching this video, I'm sure you're trying to run the numbers. You might be not be looking at a $300,000 house. Yours might be $250,000 or yours might be $350,000. And you want to see what would it impact for me. If that's the case, we have a free tool that we're going to give you. It's a spreadsheet where you can type in your information with your income. It'll give you your monthly and everything that we talk about in this video. You can get that in the comments below. Just click the link. The other thing that we're going to do is we're going to break this up into different interest rate comparisons, because interest rates are kind of going back and forth. And so part of the conversation usually becomes, well, I want to wait for a lower interest rate or, something like that. We're going to save money on that end. I'm going to show you also how the numbers are impacted based on a lower interest rate of 5.5, a middle interest rate of 6.0, and a higher interest rate of 6.5. That way you can get a full picture on how this is going to impact you short-term and long-term. So first thing that we're going to look at for Bill and Suzy and Rick and Lucy is the short-term financial impact that no down payment versus having a down payment will have on their finances. So when we talk about this, what we're really talking about is what is this cost savings on their monthly payment? Because if you put a down payment down because you're bringing down how much you're borrowing, you will have a cost savings on your monthly payments. Okay, let's talk about Bill and Suzy first. Now, these guys, remember, are purchasing a home with a down payment. So they're looking to rent. So we're under the assumption that they have rented for a full year. They've saved a $12,000 down payment. And the reason we just did a $12,000 down payment, because my assumption is you have to live somewhere. So you're going to have that rent. And so there's going to be a cost. Probably most families who are purchasing a $300,000 home, what they could comfortably put away is about $1,000 a month. Now, your situation might be a little different. This is where that spreadsheet's going to really help, and you can plug in numbers if you can make a bigger down payment and see how that affects these numbers. But we're just making the assumption that they can put away $1,000 a month on top of the rent that they also are having to pay for a place to actually live. Now, their loan amount is going to be $288,000 because they put the $12,000 down, and so their monthly mortgage is $1,635. Now, one thing that's really important to note here, we're not talking about anything that is typically added into a mortgage. So let's break this down real quick, just in case you're not aware. Oftentimes, whenever you have a monthly payment, you usually have a few numbers that are going in there. You have what you borrowed from the bank, that's your mortgage amount. And then often your mortgage will include property taxes that are paid, and then also your insurance costs. In our numbers, we are not including property tax or insurance because regardless of how you do your down payment, those numbers are going to stay the same. So it's really kind of a net zero as far as how it impacts the final number. So these numbers monthly might be a little higher once you add those items in, but in terms of cost savings, which is what the purpose of this video is, everything's going to basically stay the same. So for Bill and Suzy, who rented for a year at $2,000 a month, we're able to save an additional $1,000 a month, and we're able to get a $12,000 down payment. Their loan amount that they're actually borrowing to purchase their $300,000 home is $288,000. So that puts their monthly payment at a 5.5% interest rate at $1,635 a month. Now, let's talk about Rick and Lucy. Now, these guys got a year jump start on Bill and Suzy. Now remember, they didn't put any money down and they didn't spend any money in rent. Their loan amount is $300,000, and at 5.5% interest rate, their monthly mortgage would be $1,703. So on a short term, the cost savings is $68 a month. So you're saving $12,000 and spending $2,000 a month, so $24,000 to save $68 a month. So your break-even point in the money that you're saving at $68 a month, your break-even point to get that $24,000 back in rent and that $12,000 back in the down payment is just over 44 years. So short term, if you need that cash flow, that could be something to look at. But if you don't need that cash flow, if $68 a month isn't going to break the bank, it's going to take you a long time to recoup those costs that you paid not only in rent, but also your down payment. 44 years. Okay, let's break these up into the other interest rate points. So if you are at 6%, let's talk about what Bill and Suzy and Rick and Lucy's situation is going to be. So Bill and Suzy, they are spending $1,727 a month, while Rick and Lucy are spending $1,799 a month. So Bill and Suzy are only saving $72 a month. Let's go to the 6.5%. Bill and Lucy are looking at $1,820 a month, while Rick and Lucy are looking at $1,896 a month for a cost savings of $76. So there might be some specific use cases where you need that $76 or that $72, But overall, if you're watching this video and even weighing these costs, I have a feeling you're probably way more financially fit than most people, and that $70 a month really isn't going to make a difference for you. So on the short term, you're really not gaining a whole lot if you go down payment versus no down payment. Okay, now that we've covered the short-term financial impact, let's talk about the long-term financial impact. Because often people think if I give a better down payment, then that's going to help me in what I'm paying over the life of the loan, okay? Now, as we're talking about this, we're going to include a few things. So for Bill and Suzy, who are renting, we're going to assume again that they're spending $2,000 a month, so $24,000 in rent money that is going nowhere, and they're only doing it for 1 year. Now, caveat to this, most of the time when people start renting, they don't jump out after the year. They're going to rent longer just because they get comfortable. They don't want to make the move. You know, there's a lot of factors that can go into that. So this $24,000 could actually be a lot more if you're taking into account the money that you're spending in rent. Okay, so we're going to put all of those numbers together and see how does this impact our long term. But for these numbers, we're only considering 1 year. This is best case scenario. On the home purchase that Rick and Lucy are going to be doing sooner than Bill and Suzy, they're purchasing the same home. So we're talking $300,000 and their income, their credit, they're able to qualify. So just so we have an understanding of kind of what our baseline is and what we're looking at. So the first scenario that we're talking about for both of these couples is a lower interest rate at 5.5%. Okay. So our baseline is going to be Rick and Lucy. These guys had no down payment. They're purchasing a $300,000 home. Here's how this shakes out. Like we mentioned before, their monthly payment is going to be $1,703. Okay, so the total life of their loan with interest, everything that they have put in, if they were to stay there for the full 30 years, their total spend on this home is going to be $613,212. That's going to be the total amount. Now, I know some of that by itself freaks you out. It's just how home loans work. Whenever you add in the interest, that's just what happens. Now remember, Rick and Lucy did not put any money down. They went straight into their home purchase, skipped the apartment, skipped all of that, and used one of either a loan program that doesn't require a down payment, or they used a down payment assistance program if they have one available in their area, which they did because that's the example. Okay, so let's talk about how that differs from Bill and Suzy. So Bill and Suzy decided to rent an apartment, again, $2,000 a month. They're only renting for 1 year, so we're putting rent costs of $24,000 into this equation because that has to be factored in. Also, these guys were able to save about $1,000 a month. Now, if you can save more, get the spreadsheet, see how these numbers adjust. Maybe saving for that down payment would be a good thing for your financial situation. I can't do everybody's financial situations on this video, but we're assuming the average person can get about an extra $1,000 a month and still live comfortably, still afford their rent payment of $2,000 a month. So they're saving at the end of the year $12,000. So their monthly payment is going to be $1,635. So again, we are saving a little bit there. We kind of already talked about that. Here is their total lifetime paid. Now, when we get this number, we're including the $12,000 that they put down, and we're also including the $24,000 that they paid in rent because that's money, right? So we need to make sure that that stays in our equation. The total in lifetime costs that they're going to pay with all of that brought in, their interest, monthly payments, the rent, all of that is $624,684,000. So now when you compare that to what Rick and Suzy did, their total out-of-pocket cost was just over $613,000. So it's actually costing you $11,472 to stay and rent for an extra year. And the other thing this is not including is any equity you're losing by waiting the year to be able to get in your home, because your homes appreciate in value. That's just historically what's happened. And so if you're losing that year, you're losing that equity that you're getting on that home. Now, if you want to see how this compares out into other interest rates, get the tool that we are offering in the comments below, because we have the first tab in there. It will line all of this out, and you can toy with it yourself. But if you want just a quick spoiler alert without going over the specific each line by line, if you're at 6%, to wait to get a down payment, it's going to cost you $10,099. Still costing you money. If we're at 6.5%, it's going to cost you just under $8,700. So long term, it's actually costing you money to go rent an apartment to try to save a down payment. Now, I'm going to give you a better plan. Now, let me give you a completely different idea that you might not have thought about nor run the numbers around. Now, before I jump into this, I'm going to make a couple of assumptions. I'll assume that you have to have a place to live that you're paying for. Now, what I mean by that is you're not living in your mom's basement. You don't have a scenario where your living situation is not costing you anything. So if your living situation is not costing you anything currently, this might not make sense. But then again, if you are a financially disciplined person, it actually might. So I want you to continue to watch. So my first main assumption is you need a place to live and there's going to be a cost associated with that. My second main assumption is you don't have any money down right now. That's why you're trying to weigh these costs. So let's talk about assumption number one. The reason why that I'm assuming that is because if you're looking at renting for a year, you obviously need a place to live. And if you're watching this video, you have already kind of run some rough numbers that you can afford the place to live and save some money at the same time. So we're just going to assume that number is $2,000 for your place to live, let's say an apartment or a home. And then let's say that on top of that, you can save that $1,000, okay? So my assumption is that you are financially fit enough to be able to put away $3,000 in some form or fashion that can go towards your house or your living situation and still be able to comfortably live in every other scenario and facet of your life, okay? The thought that I would like to present to you is this. Instead of waiting to get a down payment and save money that way, if you purchased a home with no down payment right now and then applied that extra money that you have towards your house payment, it drastically changes a lot of factors around your home. To understand this a little deeper, you need to understand how your monthly payments work. So let's sidetrack for just a second and talk through that. When you are paying your monthly payment, there's something called an amortization chart. And essentially, every month, there's a percentage that goes to the interest portion that you owe, and there's a percentage that goes to the principal or the actual balance that is lowering month to month. Every month, those ratios kind of change and shift towards the principal. So for example, let's just say for easy numbers, your first month, let's say it's $1,700, your first month, about $1,200 is going to be paying just the interest and $500 is going to be going towards the principal. So your first month, let's say you have $300,000 that you owe after you close. Your first month, you're going to be paying $1,200 straight to interest, which is basically the way that the banks make their money. And then that other $500 is going to your principal. So now after month one, you go from $300,000 to $299,500 is what's owed on your loan. Now, if you make additional payments on any month of your home, that goes straight to the principal number. So it's reducing that principal number anytime you make an additional payment over whatever your standard payment is. So if your payment is $1,700 and you add $1,000 for a month, that's reducing your principal payment, which is also reducing the amount of interest that you owe month to month. So with that understanding, I want you to think about this scenario. What if you purchased a home with zero down payment through either a loan program that offers 100% financing or through some down payment assistance programs that may be available in your area? And then let's say that your payment was $1,700 a month. Let's just say $2,000 for easy math. And then that extra $1,000 that while you were renting, you were going to save for a down payment. Instead, we apply that to your mortgage. Look at what happens to the numbers. Now, we're just going to do this at the 5.5% interest rate just for the sake of the video. But again, get that spreadsheet tool and you can play with these numbers all you want and see how it affects your bottom line. There's actually two things you need to look at. Not only are you going to be saving money of total out-of-pocket costs, it's also going to reduce the time it takes you to pay that loan down. So your loan is set at a 30-year time frame. It's going to reduce that number. So let's just say we did it for just 1 year. So we purchase a home now, no down payment, or we're using a down payment assistance program that's available in your area. And then we take that extra $1,000 a month that we were going to use to save for a down payment, and we just apply that directly to our home loan that we purchased a year earlier than we expect. We would save just under $13,000, and you'd probably remove about a year off your loan. That's just if you do it for 1 year. So you're spending just an extra $1,000 a month. You do it for just 1 year, then maybe life happens, or you want that $1,000 back, you get a boat, whatever. Then and then you just make your normal monthly payments. But what would happen if, because again, you are a financially fit person, if you're watching this video considering saving money for a down payment, you've got that $3,000-ish to play with. What if you continue that for the life of the loan? So you've set up your life scenario where you can afford that much. You have your $1,700-ish a month. That is your payment that you have to make, and then you're adding an extra $1,000 a month for the life of the loan. This is where it gets cool. You're going to save $193,152 on the life of your loan. And check this out. Your loan will be paid off in 13 years. That means you will own your home in 13 years. So all of that to say this, I love it when my clients say, hey, I want to wait a year, save money for that down payment, put that towards a house, because that tells me these guys are financially fit, they are financially disciplined, they know what they're doing. But I want to make sure that you understand every facet of this, and if you adjust that thinking just a little bit, it could actually put you in a much, much stronger financial position when it comes to the purchase of your home. My name's Tony Solar. I'm a local realtor in the St. Louis area. We handle St. Charles County, Warren, Lincoln, St. Louis, anywhere of the St. Louis suburb. If you've got further questions about this, or you want to talk about your specific scenario, email me, call or text me at any time. This is my personal cell phone. Also, make sure to get this free tool that we made for you. You can play with the numbers, plug in your situation, what you think you can do, and see how it affects your bottom line. Thanks for watching.